Call the meeting of the Montana Board of Investments to order. I want to notice everybody that it is being recorded. And so keep that in mind. And I always ask Savannah, if you would you do roll call?
Of course I will. Good morning, Mr. Chair and members of the board. Jack Prothero,
Here.
Cindy Yunkin,
Here.
Porter Bennett, Tim Kober,
Here.
Maggie Peterson,
Here.
Mark Berry,
Here.
Jeff Meredith,
Here.
Dan Trost,
Here.
Dwayne Iverson,
Here.
and Senator Jeremy Trebus. Absent. We do have a quorum. Thank you, Mr. Chair.
Okay, thank you. The next thing I'll call for is public comment. Any comment from anybody on issues within the board's jurisdiction? Looking on screen, I see none. Nope. Any other comment? Hearing none. We'll move on. Next thing in the packet was the minutes of our February 28th meeting. I'll call for a motion to approve the minutes as printed.
Move to approve, Mr. Chairman.
Okay, approved. Second, Dwayne. Any corrections or comments? If not, I'll call for a vote. All those in favor of approving the minutes, please say aye.
Aye.
Any opposed, same sign. Hearing none, that's approved unanimously. We have some administrative business to do. Mark, do you want to talk about audit committee for a minute?
Yes, we had a quick meeting this morning, not a lot of business. Dan didn't have any executive director comments. Julie Feldman gave us an update on our audit charter or audit checklist regarding the SOC audit. They've conducted an entrance conference with Whipley. And Whipley and the staff are currently doing some preparation work for the SOC audit. Whipley will do their walkthrough the first week of June. Testing they expect to start in July, and expect to see a draft SOC audit in October. Julie reported all members, including board members, have signed the ethics policy and confidentiality of use. And also, the board has sent out confirmation letters to all STIP participants and TFIP participants. 190 local governments for STIP and 350 STIP or TFIP, and 355 state agency accounts. The purpose of these confirmation letters are to make sure that we have the right people that are authorized to make transactions on behalf of their accounts, and also in the TFIP accounts to let participants know how those accounts are operating. So they're getting information about who's authorized and that sort of thing. The board presented to the Public Employees Retirement Administration and to the Teachers Retirement Board as required by our audit charter. One discussion we did have regarding the SOC audit was a request that we make sure that Whipley looks at the new home or housing loan functions and make sure that they are following the policies that we approved. With that, that was all that we had to cover.
Okay, no decisions from the committee. Any questions for Mark? Hearing none, thank you. Next thing is our loan committee report, Jeff.
Sure, the loan committee met earlier this morning, reviewed two intercap loan requests, one $2.75 million request from the Columbia Falls High School District. That request was approved by the committee. The second request from the Montana Department of Transportation for $4 million was also reviewed and approved by the committee, and will be reviewed and approved by the full board as part of this meeting as well. And in addition, Dan made a brief note on a few items that he'll discuss in further detail with the full board later in this meeting. And that concluded the activities.
Okay, thank you, Jeff. Do you want to make a motion to come from loan committee to the full board to approve the Department of Transportation loan?
Yeah, so we'll from the loan committee earlier today, the request was approved and recommended for approval, noted. So yeah, I'll make a motion to have the committee, the full board review that request for approval as part at later in this meeting.
Okay, thank you. Is there a second?
Second.
Second by Mark. I want the record to show that the full board does attend the loan committee as well as audit and other committees. And so sometimes it seems like the board is just rubber stamping this, but it's not that. In fact, we're part of that review at loan committee. So with a motion to approve in a second, is there any additional comments or questions?
Can you reread the motion, just in case? It sounded like he
It's
made a
moving
motion to
approve the-
review.
So just to clarify, Jeff, it's to approve the DOT loan, correct? As it
Yeah,
was-
Okay, so is that clear for the record?
Yep.
Thank you, Dan. So we'll go ahead and vote on that. So all in favor, please say aye.
Aye.
Any opposed, same sign. That motion is approved unanimously. Anything else for Jeff?
Nothing.
Okay, thank you. We'll move on to Maggie, HR.
Thank you. First thing I want to do is just make a note for the record that Dan White is retiring, and I'd like to thank him for his service to the board and our staff. So good luck, Dan, and all you do. Enjoy Germany. Secondly, I want to make a note. We had a long meeting, so I'm trying to read all my notes here. The executive director reviewed staffing levels and compensation with us. We had a proposal before us on restructuring some of the staff, moving responsibilities around and reducing costs. That was part of the plan and the proposal. With the proposed changes, all services and needs of the board are still going to be met. We do have, as a result of all this, we currently have we'll have 4 vacant positions. Some of them probably will be filled at a later date.
All of them will be filled at a later date.
Maybe not looking exactly the same, but they will be
Correct.
filled.
Yes.
The other thing I'd like to make note of is that based on comments from staff, Peggy, and other staff that Jack and I talk to on a regular basis, morale seems to be really good here and staff are really happy in their jobs. So I want to thank our staff and you, Executive Director Villa, for the work that you do for us. It's greatly appreciated. Things are way different than when I first came on this board. So again, I appreciate it. So we do have a motion that was recommended by the committee that exempt staffing and compensation recommendations for FY25 as recommended by Executive Director Villa be approved. Do I have a motion to that? I'll make that a motion.
Yeah, please. So you've heard the motion. Second. Moved and seconded. Is there any questions or comments on that motion? Hearing and seeing none, we'll call for a vote. All those in favor of the motion, please say aye.
Aye.
Any opposed, same sign. Hearing none, that motion is approved unanimously.
One other thing I'd like to note for the committee, because I questioned the spreadsheet that we had received with the proposed increases for staff as well, that classified staff increases are going to be 4%, the greater of 4% of $3,120 that they'll receive when they get their raises. So that means anybody making under 78,000, they'll get the $3,120. I think that's a nice plus for our staff, so.
And that was the legislative pay plan for classified staff. That wasn't anything we had to do.
It's nice to see our staff receiving what they probably should receive. Maybe not as much, but at least a good bump, so. That's our committee meeting.
Okay, any questions for Maggie from anybody? Hearing none, we'll move on. Since you're on the floor, Maggie, do you want to talk about the ERS board?
Well, this will be short and sweet because we meet tomorrow. However, I'll give you an update on what we're meeting on. We are reviewing the actuarial audit that was done by McMillan. Our other actuaries, our current actuaries who are Kavanaugh and McDonald. And it was a good review. There were a few minor little recommendations they made, nothing that gave me heartburn or anything. So I think that's pretty much. We will be meeting this afternoon, the audit committee, so I'll report on that next time too, and the personnel committee, because we are in the process of trying to replace Executive Director Schwinden. So I'll give you a better update in May. So.
Thank you. Any questions? Mark?
Okay, so McMillan, was that a review of the consulting, of your consulting actually?
Yeah, with Kavanaugh.
Okay.
And it was actually a good review. I thought it was weird.
They didn't come up with totally different numbers or?
No, not at all. There wasn't anything like that. They had a couple of minor little recommendations that I kind of,
Okay.
and we had a response from Kavanaugh and McDonald. So.
Okay. And we'll see, we can see that if we want to.
Some of it you can, some of it you can't.
Okay.
Some of it's closed. But it'll be available probably after tomorrow.
Good. Any other questions? Dan, do you have a report on teachers?
This will be even shorter. We have not met since I was last here. We will meet right before our next meeting in May, so I'll have something for you then.
Okay. That's what I like. Good report, short report. Anything else, Dan, for that section?
Nope.
Okay, so then I can turn to tab 2, which is the executive director reports, and so I'll turn that over to you, Dan.
You have the memo on benchmarks. Happy to answer any questions the board may have. Next meeting will be a fairly robust one, just to prep you. We've got policy statement review, we've got some deep dives, we've got the quarterlies. I will be asking you to approve a motion to change the workforce housing project in Deer Lodge. If you remember, we previously approved it to be with one contractor. That has not gone as well as I would have hoped, so I'll be asking to approve a new project with a not to exceed number, so that we can go get that done. The subdivision is up for hearing April 15th in Deer Lodge. If anyone would like my thoughts on the Montana subdivision review process, feel free to catch me at lunch. It's fun. But otherwise, we're still on track to break ground and be under construction this summer with employees moving in this fall. As I mentioned earlier, not for everyone's consumption, so I'll mention it now. As you recall, we did discuss staff responsibilities and who we report to for the purposes of HR at D of A, and part of our request to next session is that the board manage the board staff, given our unique nature and role in state government. We wanted to have a great story to tell, asked and challenged the staff to find 9.2 million in efficiency savings or earnings. They were able to come up with over $25 million in efficiency savings or earning opportunities. So more than exceeded the goal, very proud. We will be having a pizza and crumble cookie party to celebrate. We will be rewarding some of the staff who had a large number of recommendations with 10 work from home days, and then some gift cards for others. So we're a food-based culture who also enjoys working in pajamas from time to time. But for $25 million, that's okay. Last item I wanted to talk about with Doug in the room. Last meeting, you asked us to figure out a review process for the lenders. So we went back in time a bit, and a year ago, we eliminated the requirement in policy that we do an annual review of the lenders because there was, at that time, and Doug, feel free to correct me if I'm wrong, there's no really hyper efficient way to do it, and we're still protected. So let's game theory out a bad loan. So we make a loan to company X with bank one. Bank one goes under. That loan will be purchased by bank two, and we will still be in a first lien position, and all our rights will be protected. So at that point in time, we looked at it and said, well, is it really important that bank one be reviewed every year, or is it important that the notes are structured in a way that we're protected regardless of what happens? And at that point in time, the board said, yeah, we probably don't need to do this because we will be audited if we say we do it. And if we do it on 48 and one of those banks doesn't reply, we get the finding. Is that a fair description? So, we work for you. If you would like us to come up with an annual review process, we will do it, but I didn't want to undo what we did a year ago without that additional context before the board. So,
Jeff, do you have any, being the banker, any thoughts on that?
Yeah, I do think it makes sense. You know, kind of. So, you know, I don't have anything to add. I agree.
I think, from my point of view again, John, I'd like to talk about risk. I'm not sure that there's risk there, but I do like the idea that we have an approved list of people who does business with us. And I don't think it's worth our time and effort to try to analyze every bank that we do business with, but do we have, we gonna continue to have an approved list, or how would we get somebody on or off that?
So there's no changes to the approved list. You still have to go through the board approved process and Doug's review to be able to even do business with us in a loan portfolio. If you don't check those boxes, you don't get through the door. We have a lot of folks who are approved and either came in on a one-time only basis when we had those CARES or ARPA programs and haven't really heard from them. We have our regulars, your Bank of Montana's, Glaciers, Stockman's, who we see pretty frequently. But then, you know, you've got some that are just in limbo and may come in for one loan and then sort of go away for a while. So yes, the approved lender list is important. Having a process to get on that list that we don't just take all comers is important.
But we have criteria.
Correct.
For
Doug,
that,
can you walk through the criteria for the approved lenders?
Sure. So the lender goes online, completes the application and submits it to me along with their financial information. And from that, I do my review. We do have certain requirements as far as net income requirements and capital requirements. And so as long as they've met those requirements, then I recommend approval, give it to Dan. Dan gets the final say on it. There are requirements that the lender, once they become an approved lender, you know, they sign the servicing agreement with us. And the servicing agreement outlines the responsibilities of the lender. Once they make the loan, this is what we expect them to do. If they don't meet those requirements, then we have the ability to make changes. Be it, they can no longer be an approved lender or such. But at this point, we've never had a lender get to that point.
With the consolidation in the industry, do we review the list to make sure somebody that's been merged or something that they're not on our list anymore?
Yeah, I try to keep track at least of the Montana banks. We do have some banks out of state that I don't really pay too much attention to because we don't have any activity on them. But if we did have activity on them, I would pay more attention to them.
So you feel comfortable with our process?
Yeah, I do.
Do you annually look at it, or how often do you look at those banks?
Well, if I, annually, if I hear of a bank that is being acquired by another bank, then I'll go into my folder and make the change that the bank is no longer active and that they've been acquired by another bank. It's not necessarily annually, it's just when we hear about it.
How about the ones that are approved, though? Do you look at, and they're actively doing stuff, do you look every year, or once they're approved, we don't worry about it unless
That's
something
right,
comes up?
that's correct.
So back to your point, we've never removed any bank?
Not that I'm aware of, or at least, yeah, I'm not aware of. any.
You know, it was an issue maybe in the savings and loan crisis years ago, but they were always acquired by another lender.
And that,
So,
and that's important. What Jack just said there was, if a bank fails, the loan's still there. It's out there. It's gonna get repaid and it'll get acquired by another financial institution. So that's where our risk is with that loan. Obviously, we want the bank to perform, if they're not sending us payments, if they're not doing, say, due diligence within a collection procedure, we wanna make sure that they are doing that correctly. And if they do go past due, I know about it. And I approach the lender and ask him what's going on. But in the 8 years that I've been here, we haven't had a past due loan. Yeah.
Mark?
So you have criteria or processes that you require the lenders to follow. And you're checking those to make sure that they're following those written processes that they've agreed to?
Well, I think the main check is that they make their payments to us on a timely basis. So if they show up on my past due report, I would contact the lender, find out, have they forgot to submit the report, or is the borrower actually past due? So,
And you would see that in Doug's quarterly report on the loan portfolio,
Okay.
how many are past due, and typically those are housing related, not
Mhm.
commercial related.
yeah,
And then we've, in that case, either have a HUD or an FHA or some other form of, not FHA, but a HUD guarantee on the back end or a VA guarantee, so.
So, Mark?
Would we have any concern with, because this is a very, very small state, with independence in these matters between the board and these lenders? I mean, is there any concern there, or how would you say we're protected from?
Well, we have our strong conflict of interest rules.
Okay,
And over a period of time that I've been here, there has been some board members that have not voted on certain loans because they may have worked for that bank or they have been on the board at one time of that bank or
but
something.
I'm talking about staff because we're saying we don't necessarily need to be involved in the selection of these lenders and that sort of thing, but.
So you established a criteria under policy by which we review their eligibility. So within the governance manual, you say, here's how you get in the door. And then our role is to review them against that criteria. So that's the separation of powers piece. We don't get to invent the provisions that they have to check the box on.
So I'm not sure we need a vote, but I just think the consensus is that we can stay with what we're doing and
Okay.
don't have to increase additional monitoring. Is that okay with the board without voting?
Okay, that's what I needed. Thank you.
Okay.
All right. Look at that.
Well, I got the question because you guys won't believe this, but we've spent many hours of board time on benchmarks. And we don't want to go into private equity benchmarks, Becky, I'm sorry, but anyway, it is an important topic because it's how we judge some of our investments and things. And so, John, just on a super high, super fast level, can you talk about benchmarks and maybe how you use them? And then I'd ask Becky, you to chime in too, that you think that we're doing the appropriate things on these benchmarks. John?
Sure, so, at a very high level, as, I tried to lay out in the memo, it really depends what asset class we're talking about. It gets progressively harder as we sort of get into the, private investments and real estate and real assets. You don't have that perfect benchmark. And you probably don't have that perfect benchmark anywhere really, but that's the areas we well know and have had discussions before we get hung up on sometimes. I think what we use at this point is, appropriate and gives us an idea of how we're performing against some of the public market characteristics, because at the end of the day, to the best of our ability, we're trying to come up with something to say, well, if we weren't invested over here in private equity, as an example, well, what's kind of the closest comp over there? And that, our judgment has been sort of the small cap equity world. So I think it's been an appropriate, they're appropriate benchmarks. They give us a degree of information as to whether or not we're performing over a long period of time. And I think that's really the key that we have to look at with particularly the illiquid asset classes. It's not about what we did in the quarter or what we did even in a year or two, because we know that there's going to be significant tracking error there. But over the long term, and I think you see that, I'm always trying to point you all to, kind of look at the 10-year number if we're talking about something like private equity, and you can see that we've outperformed our benchmark there. So there is some benefit to being there. Over time, if you're not seeing that sort of thing, then you sort of have to ask yourself why. But I think, it's been beneficial for us. So I would say, that what we're doing is consistent with best practices in that realm. And, more importantly, as we often point out in the quarterly board meetings, really what we're concerned about if we're talking about the retirement plans is, okay, are we meeting our actuarial hurdle? That's really our focus. That's what we're trying to beat so that we can pay benefits and fund the plans over a long period of time. So that's, really a more important benchmark at the end of the day than some of these underlying asset class benchmarks. And similarly, if we're talking about trust fund or state fund or STIP, we're probably more concerned about what's the yield within that portfolio. Those participants all have different goals there. They probably care more about cash flow and things than they do about necessarily a total return benchmark. But nonetheless, we have that information there, and it gives us good color as to whether or not we're performing well. Gives you good color as to whether or not we're performing well. So I will stop there, I guess, but happy to take any additional questions about.
Maybe just quickly reminder and briefing for those who weren't on the board. We went through a lot of change with the benchmarks from the last CIO to the current CIO. Prior to John's tenure, the investable of Samurai was the big one, and that was the one that mattered, whether or not it checked the other boxes. And John's approach has been a little more refined and holistic. So when John got on, we sort of had, the biggest first piece we did was fixed income, because you know that. But we've revised these significantly over the years since John came on board in February of 2020 and lost us $1 billion in a month. But two. So we're in a better place today than we have been, at least from my perspective.
I would say in that vein, when I look at the benchmarks now, prefer not to make changes as much as possible. You know, we're not looking to change these all the time, and you know, we've got to be fairly consistent over a long period of time. I did note the one change that we'll bring to you in May for the real assets portfolio, and you'll recall we created that in 2020, not long after I'd started as CIO, and with, you know, complexion and what's in that portfolio has changed as we have, you know, been able to add infrastructure and maybe pull back some in tips. So that's just kind of more of a reflection of where the portfolio has gone over the last few years. We just kind of didn't know where we'd be, I think, at that time frame when we created it. We didn't have a lot of infrastructure and things in that real asset portfolio. So that's why the change, which I wanted to point out in this memo, since we'll bring it to you in May.
Good. Becky, do you have a comment just on industry practices or how you think we're doing these benchmarks?
Absolutely. I do think they represent industry best practices, and the things that have been a struggle in terms of comparisons of private investments to public markets is something that every plan we work with deals with. They either come up with a public market proxy, or they just don't benchmark it and reflect the return the investment made in their overall fund performance benchmark, so they neutralize it. Not many do that. But this public market equivalent is a very common practice that we continue to support. One of the things I'd point you to is in the back of our full performance reports, there's a list of all the indices that you currently use. And in the case where those have been changed over time, we actually mentioned what the prior compositions were, so that you as a board have a chance to look at how that custom index has changed for that asset class. Say for private equity, you can look at that and have that full transparency. Because one of the things we don't want to do, and John implied this, you don't want to just change your benchmarks and then change all of your history, and then change your benchmarks and change all your history again. It makes sense to make incremental changes where there's needs, but other than the one that John had mentioned in real assets, where it doesn't now represent as much what your current composition is, that's an obvious need for change. But there's always going to be an imprecision, and when we look at the selection of indices you've selected, it is industry best practices. So no suggestions for change.
Are there any reports available that would show us where we were 10 years ago, say, 5 years ago, and where we're at now? So you can kind of see what's changed, you know, in regard to the makeup of things, the overall, because to me, we're in the long haul, and how's that doing? And watching that move tells me more than looking at a snapshot.
So like Becky said, you can see what we had prior and when we changed it. It's in all of the notes. Don't have anything else. We'll look at it, I guess. We could certainly.
But we normalize the long-term data when we change the benchmark, right? So.
Well, it doesn't change. So if we had a different benchmark and we changed it at the end of a quarter, all the historical data remains as it was. We do not change. So we're linking to.
Oh, it's still based on.
It's still based on that old benchmark. We don't change that ever. So it always just links forward to the new one. The new one would start in the next quarter and go forward, but all that historical benchmarking does not change. So it's not as if, we're not moving the goalposts.
Yeah.
And
That's the
Becky, where did
important
you
part.
say that is?
Which a lot of the other things do. when
So
you
it's
look
in
at the funds.
it's in the section 2 report of our performance report. All the way at the back, you'll have a list of manager transitions, index, common glossary definitions like we do with the MER materials, but it will show you all those historical benchmarks.
Dan, did you?
I just had a question on two of the benchmarks that I'm not as familiar with. The MSCI USA investable market, that's large, small, mid, and that's market cap weighted, or is there some other weighting going on?
Market cap weighted.
Okay. And then the high yield 2% issuer cap, is that just a way to remove concentration risk from?
So what they created that, correct me if I'm wrong, but I think when Ford dropped
Yes,
into the
Ford,
index, they created
exactly.
that because Ford went to below investment grade. and they were huge compared to the rest of the universe.
Like 12 to 13%.
Yeah,
Oh,
and so it
something.
really,
Which one is it?
too
Which
big
one
a
is that,
weight,
Dan?
so
the
you
non-core fixed income was the other one I was asking about. Okay, thanks.
Anything else? If not, I think we're done with tab 2. We've got scheduled lunch for about an hour. So it's 10 to 12, so we'll reconvene at 10 to 1. And
And
hopefully
Tim,
lunch is here.
Tim, don't worry, your cookies have been spoken for.
Stuff, but I'm just looking at, you know.
Thank you.
So Savannah is the boss, and she said we're good to go, so I'll call the meeting back to order. We rushed lunch a little bit. I was trying to give you a little nap break, but Dan didn't want to do that, so. So we're a little early, so hopefully you got a good lunch there online. And so I think we're on the back page of our agenda, tab 3. And RVK and Becky, I'll turn it over to you and go ahead. And just remember, this is after lunch and this is such an exciting topic.
This is an exciting topic. I will do my best. Do you want to see if Savannah can put the slides up, or you just want to follow along in your materials?
It's up to you.
Doesn't matter to me.
What do you think? Just the materials is good.
Okay.
It's fine.
Sounds great. Well, thanks for the time today. We're just going to provide a little bit of education and background into capital market assumptions, which are something that goes into our annual asset allocation process that we're kicking off in August with your staff. So we always look forward to that opportunity to get together and talk about the portfolios, any potential changes that staff is thinking about, our perspectives on the mixes that you have across the portfolios and any opportunities. So this is just one of the inputs that goes into that process. To look forward, we need to make some projections about very long-term asset class behavior. So one of the things that we do that we reflect in that second major bullet point is when we enter this asset allocation period, it isn't all only about the pension plans. It's about insurance monies, it's about trust monies, it's a variety of different types of investors that we're trying to capture in this overall process. And that drives, how these models work that we use to start the conversation. The mathematical models that these assumptions go into never end the conversation on what to do on asset allocation, but they give you a place to have a conversation about what changes could be considered. So when you're thinking about that for an insurance pool, the state insurance fund, for example, it's going to be a completely different paradigm in terms of how much equities are allowed and what other asset classes can be in that portfolio other than fixed income. So that is all done specially and in mind of the ultimate purpose of each one of the funds, as well as any constraints that it operates within. We also look at each one of the funds and what kind of return expectations there are over the long term as we form these portfolios with the pension plans. We talk about that a lot in terms of what's the long-term assumed rate of return. But we look at other things, and that is what's the downside market environment likely to look like for any of these pools? How much negative return could they experience in all likelihood in a short period of time? And then how does that translate to the long term? We also look at liquidity requirements. You have some funds where liquidity is a very important part of what you do, and in fact it is for the pension plans. Making those benefit payments is a key obligation of those funds. We do take that into account. So the firm itself does this high-level asset class research that then goes down into the weeds for a number of asset classes, and we do that every year. We typically start it towards the end of the year, and with the idea that we'll be able to come out with assumptions by February, and certainly by the first part of March. So this is a very important process that we involve a large number of the firm's investment professionals in. And in fact, we talk about that a little bit more detail on page 4. So we have not only our general consultants and consulting staff that are in this effort, but we also have folks that are assigned to capital market research as a significant part of what they do. We also reach into talking with our asset class officers. We have them at RBK just like you have them here in Montana. So we have folks that are just following fixed income 100% of their time, and we tap into their expertise and what managers and market strategists are thinking about these asset classes. One of the things that's very common though across the process is not only a lot of people are involved at RBK, but we also have a long-term viewpoint. That certainly gets challenged in a lot of conversations, because if you look at what's happened to inflation over the last 2 years, you can't just ignore what's going on recently while you're planning for 10 or 20 years. You have to talk about your starting point and what could happen if the Fed has to delay, for example, cutting interest rates, which we saw news this morning on inflation that says, well, it's probably that scenario where there'll be fewer rate cuts this year and there won't be as much of a decrease in interest rates as investors were thinking at the end of last year. So we do think about the long term with what's going on in the market in mind. And welcome, Paige, I see you on the screen. Thanks for joining. So the components that we're looking to forecast are expected return, expected risk, which is how much those returns move around from period to period, as well as what relationships typically can we expect between stocks and bonds. Are they correlated most of the time? No, but we have seen periods when they have, such as 2022, which was a big shock for investors. So we look at all these relationships over rolling periods of time in the case of correlation. And when we're thinking about how to project investment returns, expected investment returns forward for these various asset class tools, we're thinking just investing in index funds, because every client has a different view on how much to index equities, for example, in US and international. There are some asset classes that you can't index, like real estate, for example, traditional real estate. So we do account for the fact that you're going to pay a fee to buy properties, but we're not assuming that you're generating a large amount of excess return in doing that. So indexes is primarily what we're basing the process on. And because we do this every year, it's like guiding an aircraft carrier. You don't make a lot of shifts that are dramatic in your course of guiding a pension plan, for example. You're looking at small corrections or changes that are needed to stay on course. And that's the relationships between asset classes, because it will influence how the model selects what investments are appropriate at a level of risk that the pension plans or the trust fund or the insurance pool needs to shoot for. So we look at relative accuracy, and I'll give you an example of that in a couple minutes. But we're also trying to do our best to get the assumptions right over the long term. So individual absolute accuracy does matter. There are some consulting firms that like to tell clients what they want to hear, and they generally err on the more optimistic side. That really doesn't help a fiduciary who's trying to make prudent investments. It gives you a sense of hope that may not be as real. And yet we don't want to be the folks that are saying the world is falling apart. And there are some investment managers that are famous, like GMO, who has constantly said that for many years that the domestic equity market should have a negative return when you account for inflation, because they are so value oriented and they find very little attractive prospects in a lot of asset classes. So there is a happy medium somewhere between those two, where your numbers are grounded in data and in structure and are realistic, and that's where we try to be. On page 6, just to give you a little bit of a historical viewpoint, if you look at the last period of history dating back to 1926 and create rolling 20-year returns for, at the top of the page, 4 asset classes, so US stocks, large cap stocks, small cap stocks, US fixed income and inflation, you could see that the historical range of actual returns has been all over the place for equities. Everything from a high of exceeding 17, 18%, all the way down to 20-year periods where you had single-digit returns that were very, very low. So that's what the 20-year history, rolling 20-year periods have actually shown us dating back to the early part of the last century. If we look at where our current long-term return expectations are, those are the blue dots. And you can see that because we've had such a rich and recent run in equity returns, for example, in this period, we don't have a dot that expects that we're going to have wonderful equity markets going forward, and we'll talk about the reasons why. But a productive return for U.S. equities is expected. Small cap has a little bit better returns on the right-hand side, showing that small caps over time have outperformed large caps in 20-year rolling periods. Fixed income is the brown. That is showing you returns that are much more modest. And you can see where the current expected return sits, and then inflation is sort of the middle of that green bar, maybe a little bit to the left, because we've already seen inflation come down from 9 a couple of years ago down to its current levels where we're seeing around 3%. So if you look at our 2024 expected returns, again in the dots, compared to what we forecasted going back to 2006, you can see that in some cases, like in equities, especially in US equities, we have a lower expected return relative to the expectations we've had in the past going back to 2006, but not on the lowest end. In the case of emerging markets, we actually have a fairly high expected return for emerging markets relative to our history of setting assumptions. And part of that is the emerging markets are cheap right now. And they actually pay a good dividend, which is part of the building blocks I'll review in just a moment. Bonds, on the other hand, you can see that the black dot relative to the history of our assumptions looks pretty darn good. We've already seen yields come down at the end of last year. Now they're back up again. We'll see what happens when the Fed starts their activity there, at least for shorter term securities like federal funds, the federal funds rate indicators, but fairly constructive returns relative to history on bonds. High yield also fairly constructive because yields are fairly high. Real estate, we're kind of on the lower end of the assumed returns from the past due to a number of things that I'll go through, but one of them is some real estate investors were looking for yield and were able to get yield from lease payments when fixed income yields were so low. And that's really not the case at this point. Yields are much more attractive and are starting to compete or exceed some of the yields that you get or lease payments from real estate. So this is just a snapshot. Private equity, you may say, well, why is the black dot towards the left-hand side of the assumed returns that we've had over the history? Well, look at how much dry powder investors have committed but has not been called by the managers. There's a lot of capital overhanging the private equity markets right now to the tune of about $3 trillion. So you start looking at that and what's been happening with the IPO market really since the Silicon Bank experience. And there's a lot of reason to be a little bit more sanguine about private equity returns. And yet we think it has a better expected return than traditional equities and continue to believe that is the case. When we look at our current assumptions on the next page, page 7, again, the black dots is showing you where our expected returns are. This is actually showing you the range of returns that are possible within this assumption set. So we forecast volatility being defined as how much returns could vary. And one thing that should jump off the page is how wide the blue bars are. In equities, there's a much bigger range of possible returns compared to anything that's fixed income. And when you look at real estate, it's somewhere in the middle of the two, and private equity has a very broad range of possible returns. So the themes for this year's assumptions on page 8, we show in 3 different comparisons or 3 different summarizations of that behavior for this year. One is we kept inflation the same as our last set of assumptions. There's both deflationary and inflationary forces at work in our economy at this point. We also see that there were some investments that did incredibly well last year. That was a big surprise, like domestic US equities had a huge return last year. And a lot of that was due to the euphoria about the impacts of AI in the long term. It was on the back of a few technology-oriented stocks, and that has started to mitigate a little bit even as we go into 2024. But there were some reasons to have a little bit more conservative view on the asset classes that were priced so richly coming into this process. And then finally, fixed income. We have a lot of investors with a lot of fixed income, like insurance companies in your insurance pool, and they're finally excited about fixed income returns because yields are higher. That was certainly kept the same as the same type of view we had of the fixed income markets in the same process last year. So the full set of the core asset classes, there's more beyond what you see on page 9 that we set assumptions for. But when you're just trying to capture relative movement compared to last year, you can see that summarized on the right-hand side. And under the change column, you've got the nominal return. And if it's in that pinkish red color, it went down. If it's green, that is a case of an assumption going up. And a nominal return is really a return that's impacted by risk. And those, for the most part, showed some small adjustments. So year over year, there's not a huge message here, other than we pulled a little bit of expected return off of some equity categories and kept fixed income fairly similar, and real estate fairly similar, inflation similar. So with that, I'll make sure you don't fall asleep because I will increase the pace of the review of the rest of this presentation. But I wanted to give you a flavor how much changed so that you have an indication of how much we need to dig into some of these changes. So pretty small changes. The asset classes on page 10, we actually display on a comparison chart. This is kind of interesting. We actually have what we call a geometric return that takes our assumed arithmetic return and actually impact that asset class by the risk profile we believe that asset class has. And when you do that, it's interesting to note that the best expected return of all these asset classes that we set assumptions for is emerging markets equity. So at about 8.5%, private equity comes in at about 7.6, which is right in line with what we think international equity investments will be. So, that's one message in that we have a wide variety of asset classes we've put here. One message when you look at this particular chart in blue is all the traditional equities or equities in the alternative area, so it includes private equity. So when you kind of look at where equities sit, they have some of the best expected returns, but they don't have a corner on that market. There are some equity types of securities that have a lower expected return than even some real assets or fixed income. On the right-hand side, there's a number of fixed income asset classes that have very productive returns that are an important part of your portfolio, but in and of themselves, they have a lower return than what you would expect for some of the more volatile asset classes. So the other message that's really important is asset allocation isn't just picking the asset classes off this page that meet your assumed return in isolation. If you did that, there'd only be a few investments that you would pursue. If you had an assumed return of, for example, 7.3, which is the assumed rate of return for the pension plans, it actually takes a diversified portfolio to meet the overall risk and return needs that the pensions and the insurance pool and trust fund pools really need at the end of the day. So it isn't just as simple of exercise as just picking those that meet your needs at that very superficial level. When you put all the assumptions together on page 11, again, trying to give you a sense for how different or similar it is relative to last year. In blue are the new assumptions. In yellow in the dotted line is the assumptions from last year, and as typical, risk is shown as you see horizontally and expected return is shown vertically. Basically, there was just an ever so slight shift down in terms of expected return. And you can see here, not a lot of change relative to what it looked like last year. So again, fairly similar to how we saw the world in last year's process. The other assumption that we haven't talked about yet is correlation. We've mentioned, and as on page 12 defines, it's a quantitative measure of the degree to which investments move together or similarly and in magnitude. So diversification opportunities exist because asset classes are different or affected by different factors, but we do set these expectations for the forward period, long-term period, between asset classes so that we're able to build diversified portfolios. And you can just look at how some of those relationships stack up. If you look down the first column, that's broad US equity. That's everything from small cap to large cap US equity. And its relationship to itself, of course, is perfect. It's 100% or 1.0. As you look down its relationship down the column to other asset classes, you can see here that there's a little diversification by combining international with domestic equities, just a bit, not a lot, but some. At the end of the day, they're still equities. But when you combine fixed income with equities, only about 24% of the time do they move together as equities. That is a good diversification opportunity. Another one you can pick off this chart is core real estate at 0.28. That's 2/3 of the way down the page. Private equity, it is valued at different times. It's a long-term hold. It doesn't vary every day like our traditional equities do vary. But at the end of the day, you'll find that many of those investments exit into the equity market through the IPO market or merge with other companies. So there is a fundamental similarity over the longest term between private equity and traditional equity. So one of the things we plug into the model is not only the expected return for every asset class, but the expected risk, as well as the correlation among all of these investments. Just a little bit of a peek into the secret sauce of setting these expectations is on page 13. It's actually pretty simple. It's complex in that this is just one model that we look at, and this is written up in a white paper, as you know, every year that we have available for anyone who really wants some detailed reading on the process and the assumptions and their outcome. But many of them you can think about being a building block. You start when you're thinking about setting expectations for public equity, you start with the income that equity pays, which is dividend yield. You add to that expected inflation. You add to that whether earnings are growing or not. And is there any currency effect? Here in the US, there isn't for US equities, but there is for international equities. And then are they expensive or cheap? It's like building a layer cake. And one of the things that typically can happen is if an asset class is expensive, you can actually find that it takes away from expected return because we think its price will moderate over time. So we go through that process for fixed income, building on dividend or on interest income, as well as what's happening with spreads, what's happening with the shape of the yield curve. But it's quite a simple process when you think about this particular methodology. You can see under real estate, to my comments, it's built off of income, which is lease income, plus inflation, plus changes in valuation, and then we're taking out, because there isn't an index there to model the impact of management fees. There are some asset classes as you go down the page that we're basing off of some of the core assumptions from the top of the page and adding a spread to it. One of the examples of that is private equity. At the end of the day, we need a premium for investing in private strategies relative to the public markets. And so we're adding a premium. Over the history of private equity, it's varied from, it was negative last year, but most of the time it's varied between 2 and 5% over the return of public markets. And we're actually looking at something that's closer to a little over 2% going forward. So that's an example of a spread methodology. And there are others like private credit, which is private fixed income. And we actually have bank loans that are a good proxy for a liquid investment that we add a return premium to. So that's one example of methodologies that we use. So, again, further diving into the process, if you look on page 16, this is looking at building the cake or building the expected return for equities, just to give you a flavor. And this isn't just, as I mentioned, the only model we use to build expected returns for equities, but it's interesting to note some of the differences when you look at some of these components. First of all, when you look at the leftmost column for large cap US equities, you can see that that gray is underwater. That's actually negative. That's saying because US equities are so expensive, in fact, they rank in some of the most expensive equity pricing we've seen in history, like the 93rd percentile, most expensive. So we have taken shaved a little bit of expected return off because we think that that won't likely stay the case at that level. And then we add to it inflation. 2.5% is our expected inflation in the US. Add to that what's going on with earnings growth and yield. One of the interesting things that when we look at this particular chart, you can see that yield, if you look across the yellows, the darker yellows across all the columns, and from the middle to the right are non-US strategies, you can see that yield, actually the darker is inflation. You can see inflation is different as we look across the world. In the US, it's that 2.5. In developed non-US countries, inflation's been coming down and it's lower than what it is here in the US. So we're building that as a smaller yellow rod component, if you will. And then in emerging markets, it's actually higher than it is here. It's almost 3%. So we're building that in. Now, if we look at earnings yield, dividend yield in this case, you can see that it's the opposite of some of the trends I just mentioned, where non-US markets, even the developed large cap international markets, has a dividend yield that is about 1.3% better than here in the US. People don't really think about that. They just think of the total return for an equity, but part of that is the income that you get. And in non-US markets, it's bigger than it is here in the US. Part of that is, we look at the types of companies that are here in the US. We have a different mixture of sector dominance. In the US, we have a lot of industries that reinvest heavily rather than pay out in yield. But that is something that is a consideration for non-US markets. Earnings growth, when you look at the earnings per share growth for the companies here in the US, it's pretty good. It's that light gray section. It's not as good in the developed non-US world. And when we look at emerging markets, it's even bigger. So, currency, people think about, are we expecting any kind of positive impact from currency translation? And a tiny bit. We think the US dollar has been quite strong for a long time. And we think there's just a very small effect where we think that will probably weaken somewhat and return more towards normal and provide a little bit additional return for non-US strategies. So this is the layer cake approach that is one of the inputs into the US and non-US equity assumption building. On the next page, we actually go into detail on the US. On page 17, one of the things that's interesting to note is we've got this scatter chart on the bottom left-hand side that actually looks at the price to earnings ratio at the beginning of a period and then what the 10-year return was after that point. And one of the things we find is, in general, if the price to earnings ratio is shown horizontally, the higher the price going into a 10-year period, typically the lower the return for that asset is in the next 10 years. Kind of makes sense. If you're starting expensive, then it's kind of a headwind, if you will, into returns going forward. And we've done this study looking at periods going back to 1926 all the way up to more current periods. And one of the things that you'll note is we've been in a bit of an exceptional period where 2010 through 2013 is the black dots. And their price to earnings ratios were somewhere around the low 20s. And yet the return for the next 10 years was pretty darn good. It's almost at the stack of all, or at the top of all of those dots. It's been an exceptional period when you think about what happened in this particular case. It's a shorter period. It's 2010 through 2013. Looking at that data, we had a lot of Fed stimulus that was in the market. The Fed was really supporting the functioning of markets. And we saw that a lot of asset classes like fixed income had lower yields because the Fed was moving yields down. So it was a bit of an unusual period there. But in general, when we find that when stocks are expensive, the next 10 years tends to be a lower expected return as a result. Not perfectly, it's not a strong indicator here as you would see from the slope of the line, but it's one of the things that we do take into account.
Becky, just
Yeah.
on that. So we're a perpetual fund with our equity portfolio, so it has somewhat less of an impact on us because it'll work itself out over time.
Right.
But we're in the middle of this pension review committee and the DC conversation continually pops up. So tell me if I'm misreading that chart. If I am a brand new prison guard at Montana State Prison starting January 1st, and I'm in the DC plan,
Yep.
and I start buying into the public equities because that's primarily what you have access to early in your career, target date funds, the rest. This would have a not insignificant impact on my retirement income.
It very much could, especially if you didn't adapt your asset allocation. One of the things that the pension plans do here is you plan for the long term. You plan because you know what your liabilities are looking like. You're constantly looking at that health. And you have a lot of models your actuaries use to look at liabilities, and you're looking at the asset side and the work that we do with you. If you think about the average DC participant, one of the things we're very cognizant of is that a lot of those participants don't have that same background and tools available to them. They may use some financial modeling software to help them with that. But we're cognizant that a lot of times they're investing based on the actual numbers they're seeing in their statement. And that can influence, if they look at something that did really well in 2023, like large cap US equities, they may say, I want more of that. Now, if they're a brand new entrant into the DC plan, they've got a lot of years to make up for the losses that could happen by buying a very expensive asset class that then falls in value. But if you have someone that's going further into their career, they can't afford, they don't have time to make up for those losses during their working life, or may not be able to. So what you can think about is the DC plan investor, if they want to use an asset allocation-like approach, they would choose either the TRD suite that's offered, because that offers them the same kinds of structures that we're talking about here today, diversified portfolios. And in their case, they change through time. The closer they get to retirement, the more they become more conservative and more investments are in fixed income and cash. So the risk in a DC plan is that participants make that decision for themselves. They can choose one route where it's done for them and links to their age, which is linked to a typical time till retirement. But if they do it themselves, it is much more difficult unless they're financially savvy or have a financial planner, or if there are models and software made available to the DC plan.
If they had a financial planner, stuff like that, typically they pay 1% fee on the value of the account to have
Fees
that.
can be a big deal, yeah.
Yeah, and so your yield gonna go down, how much you're paying fees inside the mutual fund that are greater than what our fees are total. You know, and so you're looking at losing 1.25% to 1.5% of what the yield is here, basically is what I see.
Well, and typically, a lot of DC plans, and yours does as well, will have, a tranche of investment options and offering that's index funds that are cheap, not as cheap as yours. They don't get cheaper than yours when it comes to index funds, unless it's an enormous fund that has even more assets than you do. But participants will also typically be given that choice of an active manager, which is going to be the more expensive option, or an index, or having someone else do it for you in the form of a TRD. But if they do choose a financial planner, then you have to look at what fees that they're paying them.
And if you look at the last 5 years, how many financial planners have walked away from the deal of being more conservative in the later years of a retiree? Because there wasn't any return there in the fixed markets.
Yeah.
Okay, and a lot of people lost a lot of assets during that time frame being structured wrong.
Yeah.
And stuff, and so that's where, how many of the public out there that would be in the defined contribution would be capable of doing the right thing?
It's a challenge. Did that answer your question?
Yes, thank you.
International is on the next page. We look at, again, similar components. One of the things, well, we mentioned a number of the things that inflation is actually lower in some markets than it is here in the US, so that layer of the cake would be smaller, but valuations aren't as expensive outside the US. So very small changes, as you can see in the upper section of that page, very small adjustments to expected returns. Fixed income is a different animal altogether. Our capital markets lead likes to say, yield is destiny. Most of your return from fixed income is yield.
He's gonna say that all the time now.
So when you look here at that chart, just look at the dots or the little squares. They're totally different. They aren't spread all over the place. They follow this line that actually looks at your yields versus the forward return from the aggregate in this case. There's a tight relationship there. We looked at multiple time periods here. So that has a big impact into our assumed returns, is what do we think yields are likely to do in the future. There are other types of fixed income that you're invested in on page 20. You have high yield, emerging markets, you look at a number of these markets, and it's been interesting to follow them over time, but we have a similar discipline where we're looking at where yields are today and what could change as a result of that. And again, very small changes, as you see here. There was a little bit of a tick down in yields in the emerging markets that we reflected here that you can see that resulted in some of those slightly reduced returns. But again, pretty small changes. Real estate, we mentioned a little bit on page 21 about how investors in the past had lease yields and lease income from real estate that exceeded the yields they could get in the fixed income markets. Cap rates are the way we express it in real estate. You can see here the 3-month rolling cap rates and the chart there in the left-hand side of this page that were around 8% in 2003 and then have ticked down to something, as you can see, about 4%. And when you look at what's been happening with the 10-year Treasury, there was a very low 4%, went down to 2%, even lower than 2%, close to 0%, and now is back up to about 4.6. So when these real estate properties are priced, that cap rate has an impact on its value, and that has certainly had an impact. Plus, we all know and have talked about in the last several meetings, what's been happening in certain property types is the Class A office building in large cities. Is that going to change fundamentally going forward? On private equity, we talked a little bit about that already in terms of we set the expectations based on the fact that we believe at the end of the day it's an equity. So we should look at liquid equities. The particular chart you see here on the left-hand side is looking at, in green, the year-by-year return differential between liquid equities and private equities here in the US. And as I mentioned, last year, it actually ended up being negative. And much of that was because private equity was still getting current prices as we went through the end of last year that reflected a much different environment than marketable equities, which were going to the sky because of AI and because we were going to have a very productive year for equities because the Fed was going to cut interest rates. Well, if we look at a longer period and don't just judge what we expect from private equity based on a year, which we should never do, you can see that the average return differential for rolling 10 years and rolling 20 years has been between 2 and 5%. So as we look forward, we think it'll be north of that 2%. And then inflation, you know, we could probably talk all day about inflation, although that's mostly what you read in the financial news, is speculation. Now you probably saw in the news today, there's something like only a 20% chance that the Fed will move in June to cut interest rates. Now most of the expectation is later in the year. So inflation is proving to be a little stickier to get to that 2% that the Fed wants. And it's because of a variety of impacts. And we only show here one component that we look at, and that is what's happening with the supply of money. And certainly what is inflationary is in the chart with the lines. The money supply has just gone almost off the charts. If you look here relative to 1960, isn't that an incredible increase in the money supply? But yet, is that money turning over? Is it getting lent? Is it moving? Not as much as you would expect. And that's disinflationary. So the money supply increasing is inflationary, but the fact that it isn't being used as much as you would expect is disinflationary. So there's a number of forces here. And when we look at market indicators, which is at the bottom of the page, inflation expectations are still just north of 2% in the long term. Doesn't mean we're getting there right away. But if you look at 10 to 20 years, we think it's very likely we'll end up in that range.
So in that money supply, is deficit spending part of that additional money there?
Yeah. Yes. There's a lot of components to it that we could talk about, but there's just a lot of money in the system because of stimulus that we have seen. So,
Especially,
yeah.
theories why the velocity has declined so much?
Well, you know, there was some recent examples. One of them, if you just look at human behavior, when we went through the pandemic period and a lot of payouts were made, the hope was that people would spend that stimulus, and yet savings rates went up because human beings react and say, I need to protect my household against not having as stable an income as what I had before. So I'm going to keep it in the bank longer.
Well, it looks like they waited 6 months and then they spent it all.
Yeah, exactly.
They went on vacation.
Isn't that also human behavior? I'm going to
Yeah.
think long term, but that long term is 6 months.
I just mean from the 1990s to today.
Yeah,
And I know it's not a huge range in the chart, but it does look significant.
yeah, it definitely is. So this is just a taste of all the fun that we go through in a couple-month period every year, and then document our findings. What's next is we meet in August, as I mentioned, and run some models together. And Paige is the person that does the magic with the models. So we'll typically go into those August meetings with your staff, testing out various potential changes to the portfolios. And then in that meeting, literally, we can say, hey, Paige, I want to change this particular asset class and see what happens if it's 2% less, and then add another to an asset class, and she can tell us what that does to the expected return of the portfolio. But it's been a great experience in that we look at it, John looks at it, his entire staff and cabinet looks at it, and we'll typically model several ideas in those meetings for each one of the types of portfolios that you run. I don't know if you have any further commentary on that, John.
No.
Okay.
That's what we do.
So that's the introduction to capital market assumptions this year, a little bit of a discussion about the process that we go through. And we're looking forward to August.
So I've got a question for you, John. I know this is one tool we use, but we use other tools too, other people's assumptions. Can you just talk about the practical effects of how you look at some things like this?
Yeah, I mean, I guess to take it all the way back, I mean, first and foremost, none of us can predict the future. So we look at stuff like this, and I think sometimes some people look at this and think it offers a level of precision that it simply doesn't. You know, it gives you an indication of which way you should go, what might be a valuable change. But along those lines, Jack, as we go through this process, I mean, over the last several years, you know, RBK obviously spends a lot of time on this. They do a great job with their capital market assumptions. But we've looked at it and said, well, we also want to see what's the rest of the market think as well. So we've had them run the Horizon actuarial assumptions in the past, which Horizon is a survey of 25 or 30 kind of big players in the market. Everybody puts out capital market assumptions, you know, JP Morgan, other consultants, et cetera. And as Becky noted earlier, you know, you've got everything from probably GMO that is in there probably, I think, and has, you know, a more pessimistic view versus, I don't know, somebody else that's extremely optimistic. But at least you kind of get that law of large numbers and you get, okay, here's what the broad market sort of thinks or comes to. And so we like to look at that as well as sort of a check. And at the end of the day, again, Becky touched on this earlier on, it's generally directional and relative to the other asset classes, because really you're trying to make a decision on, well, do I want to add to private equity because I think, you know, there's better value there versus fixed income or whatever it may be. And if you look across the spectrum of all those players that are putting out capital market assumptions, you will generally see the same thing. In other words, you know, okay, fixed income is going to offer you a lower return than private equity is. And so it's just a way to try to triangulate, but it's not a perfect process by any means. But it's kind of the best thing that we have at this point in time to make those types of decisions.
And we,
Been practicing that.
right, it's always a disturbing saying, isn't it?
Well, but I
Practicing
mean,
those.
if you look at it,
Yeah.
I mean, you got this sample you did trying the drug out, you don't know what the impact's gonna be.
Yeah.
And eventually you see the fallout from that.
You study it post.
Yeah.
One of the things that we'll typically do is a couple steps after we come up with our assumptions, then there's a group of firms that tend to put out their assumptions early that we can look at, you know, to do this peer review that John mentioned. And we're part of that Horizon survey, which is a much larger group, but JP Morgan usually is out in the marketplace early, Wellington's usually early. So there's a group of 5 or 6 other sources that we can look at and compare where we are. And we'll compare what their assumption set is. We look at the business they have to see if it's funny, if you take a shop that's equity oriented and you ask them about the expected return for equities, unless they're a deep value manager, they're probably gonna be a little bit more optimistic. Same with, you know, fixed income shops are always gonna be conservative for the most part. But we do look at that. The other thing we do before we publish this is we put together the assumption set. A group of us, and Jim and I are part of that group, actually look at this and triangulate to make sure that the assumption set hangs together as a line, a capital markets line, and that there isn't anything that is disturbing about any one assumption. We'll actually then have a full meeting with all the consultants, and everyone has to buy off on these. And then we actually have a meeting and we test what the assumptions do to a 70-30 portfolio, 70% equity, 30% fixed income, and then a more balanced portfolio, and then an insurance portfolio that would be mostly fixed income, just to see, is there any unintended consequences here that we need to dig into? So these are all really important points. You know, the worst thing you can do is just accept a capital market assumption set without asking questions, We really have to, and make sure that they're just another input into the process.
As some legislators who will remain nameless have inferred in front of numerous committees that the capital market assumptions prepared by RVK don't get to the 7.3%. Ergo, we'll never hit the 7.3%. And actually, next meeting, I will have to go over to the State Administration Veterans Affairs Committee for part of the morning to explain why, for the 7th year in a row, that is not the case.
That's right.
From, yes, the same legislator.
Not from that line where it says 7.3 and there's very few that were voted.
Well, I think the last time he was here was like, okay, well, based on your portfolio and the Monte Carlo, arithmetic return of 6.93. Screaming throughout the halls of the Capitol, the board's own consultant says they can't get to the hurdle, and it's like, anywho.
Yeah, a lot of details always get left when those conversations had, and an important detail is this board has done a great job, along with your staff, in investing your portfolio and beating your benchmark, which is mostly indexes, and these assumptions are indexes. So, your execution of your asset allocation plan has worked well. You've earned additional returns beyond that index.
Okay, any questions? Paige, I don't want you sleeping there. Do you have anything you'd like to talk to us about, or criticism of Becky or anything?
Feel free, Paige.
I would never criticize Becky. Good afternoon. It's nice to see everyone. No, Mr. Chairman, I don't have anything further to add.
Okay, well, thank you.
Thanks for the time.
Thank you too. So we're gonna continue on. Where's that John? Hi, John.
Willie's actually gonna join us, and I
Okay.
told him I would go get him when he is up. We need to get some of these other people talking to you guys.
So where's Jim now?
He was planning to dial in and he's in New York today.
Oh, moving
And
on.
he had someone schedule another meeting, so he was gonna try to be here, but I think it went wrong.
Okay. So Willie, welcome.
You.
We're hoping that you can do a little better than John normally does.
Challenge accepted.
And it's not an easy thing.
Well, Mr. Chair, members of the board, I'm Willie Gross, member of the fixed income team, here to talk about the Old Fund Liability Defeasance Fund. This is a new separately managed account that will be used to defease the remaining liability associated with the old fund at State Fund. It will be funded through the debt and liability free account, and it will be expendable. It can be invested in STIP, US Treasuries, US agencies, Montana Bank DDAs, and trust fund. And so the plan is to invest almost exclusively in STIP at the beginning until we get a feel for cash flows. Once we get a feel for cash flows, we will transition to a strategic combination of investments in STIP and the longer term options. That's all I have. If you have any questions, I'll be happy to answer.
Okay, what can this fund be invested in again?
So it's STIP, US Treasuries, US agencies, Montana Bank DDAs, and trust fund.
Okay.
How big a fund is it gonna start out at above?
So, great question.
That means
The
you don't
governor's
know
off-
the answer.
Well, it's not our decision.
Oh, okay.
So the governor's office will determine under the provisions of House Bill 325 last session, how much to deposit into the defeasance account.
The governor's office will determine that?
The governor, the Office of Budget and Program Planning will determine that. They, under the bill, have the ability to negotiate with the state fund to do that. And at that point, there would be some sort of transfer from this account to state fund. They have the ability to not do anything and just leave the money here and pay the old fund liabilities out of this account as opposed to the general fund. Or they can change statute next session and say that instead of it be the old fund being a liability of the state general fund, it would be a liability of this account. So they'll have some legwork to do. The the unaudited ACFR numbers for the old fund is 39.25 million. That does not include the reimbursements back to June of 23 that the general fund has paid. So the debt and liability free account could be billed for the full amount, which is about $6.5 million a year. And they could retro reimburse the general fund for that amount. So long way of saying somewhere between 39.25 million on the low end and high 40s, low 50s on the north. They will tell us how much to move.
Is there a time frame for that?
Like, I bet this one they'll want to move relatively quickly. If they get that, the sooner they reimburse the general fund, the sooner the fund balance goes up. And that's, that matters.
What's the general fund balance now?
I have no idea.
Where's, okay, the debt-free, or the state debt and liability-free account is located currently where?
We have a separately managed account for that.
Okay, but what kind of fund is that in?
It is a state special account.
Okay, currently. And
Currently.
it would stay in the state special account when you create this?
So this SMA will be under the debt and liability free account until 2027 when it expires.
In the state special?
For the purposes of their accounting, yes, it will remain a state special account.
Okay. Because the law says that the general fund is funding the old fund liability.
Yes, but there's also another section of code that says you'll spend non-general fund first, and the statutory appropriation within the debt and liability free account allows this to be spent first.
Where's the money been in the past? Has been part of the general fund payout with the budget? Is what they've been doing for the old fund liability in the past?
Yep, there is
And the money
a,
was just buried within the state funds then?
the current old fund payments come from a non-budgeted statutory appropriation. So whatever the state fund says that number is, the Department of Administration and Budget Office just transfer over.
They have to spend it.
They have to spend it, yep.
But I mean, it's all part of the state budget right now.
It
And
would
they're gonna
be,
move that away is what they're trying to do then.
yes, they're paying off that debt by, at this point, a
Monetizing
defeasance account.
Is what they're
Yep.
doing.
And then they could settle it, they could leave it alone, they could change the code that it comes out of this account. They've got options. The biggest thing for them is it won't be a draw on the general fund any longer.
Okay, so how quickly do they need to make that change? They need to make it.
The payments go to state fund monthly. It's about $350,000 a month. So the sooner they fund the account and then direct D of A to reverse the charges back to June, the general fund will get that credit.
Do they need legislation to do that?
No. The legislation that created the debt liability free account gave them the authority to do that.
So, they're gonna fund the whole thing and then Willie's going to start investing those funds.
Correct. It'll be a step-to-step transaction. So it'll be debt liability free, step to old fund defeasance,
But right
step.
now that liability-free account is in STIP?
Yes, it expires at the end of 2027, so it wasn't really ideal to put into trust fund.
So what you're gonna do is you'll use STIP initially and then move it to investments so we can earn more than STIP because we can use longer term, once you know how to manage the funds, basically going out.
To be more blunt, once they decide how they're going to terminate the liability, are they just gonna leave it in the defeasance account, make it a permanent fund of the state, and then pay it out of that? Are they going to do some sort of transfer to the state fund and terminate the entirety of the statute of the old fund liability on some sort of agreement? Until we know how the legislature and the governor's office is gonna deal with this permanent fix, the best we can do is step to step, and then following next session, I mean, it would make a lot of sense to put up some of this in trust fund, because it's a 50-year tail.
Well, what I would guess their look is you could earn more than the short term, and so if they could do that, it would decrease that liability having to be funded if you could make a better assumption on it.
Absolutely, it's whether or not they get an agreement with the state fund, and if they don't get an agreement with the state fund, then it'll be a totally separate conversation of just us and them.
Okay, any other questions?
One more question, Dan. Is there out of all those numbers you just threw out there, is there a number of an amount on that old fund liability, or is it just outstanding possibilities under the old fund?
It's an actuarial assumption reflected in the ACFR at this point. There's other numbers behind it that the state fund has that we haven't seen, and I don't believe the budget office has seen either. You know, I think there's going to have to be some numerical link between how much is transferred in and how much an actuary says should be transferred in. But again, that's not our call.
Right. But that's all based on that 50-year tail you mentioned?
Yes.
And when was the old fund, when did it stop? You remember?
94. 94.
94, okay, and a 50-year tail, so, okay, we only have another 20 years to go, right?
You know, what's driving the old fund, there's not that many claims left,
Right.
Right,
but there's like half a dozen claims that cost all the money.
Mhm.
and any potential claim should have been made by now, 30 years later, you would think.
Oh, yeah, no, but if you look at it, if you look at the actuarial studies, they'll say that there's new claims, and I don't know where that comes from, but they show up.
Hard to prove a new claim under something that happened prior to 1994.
Correct.
I mean, that's what they'd have to do, but, okay. All right, thank you.
But basically, it's a defined benefit plan with no additional money coming in.
Well,
It's a
You know what
defined.
the payout is until people die, but I mean, it's still, you got the payout schedule, and there's no additional money coming in unless it doesn't fund it, then the state owes it.
the biggest cost in the old fund is the medical side,
Mhm.
and that's an unknown. And that's where the actuary estimates are iffy at best. But on the actual compensation side for, benefits, that's fairly fixed. But the old fund is a whole different animal because you had benefits paid in perpetuity for surviving spouses and stuff, so.
Paying off debt isn't as easy as it would appear. But the cash is there. They'd like to defease this. No, we know it's a liability. The question is, what's the dollar amount of that liability? And over the longer term, who owns that liability? Is it sold to someone? Is it negotiated settlement? Is it defeased and paid out of a certain account with a fallback? That's all statutory construction. That's not our lane.
But from a budget standpoint, it makes it easier. They don't have that variable sitting there any longer, at least
Right.
for the immediate future.
Right, right.
That's what
The current budget director will be able to sleep at night knowing that between now and when he's no longer budget director, there's money to pay it.
I'm glad the former budget director doesn't seem to be worried.
That's not one of my problems.
Okay, anything else? If not, thank you.
Thank you.
I think you did accomplish the goal. You were better than John.
Doesn't take any action on our part to do it, does it?
You need to adopt the investment policy statement.
Okay, we need it up, it's here then.
Yep.
So Dwayne, do you want to make a motion?
I did.
He did.
He did. Moved and seconded. Any other questions or anything? Not, call for a vote. All those in favor of adopting the policy statement, say aye.
Aye.
Any opposed, same sign? Hearing none, adopted unanimously. You said we were not voting on anything in the afternoon, didn't we?
I will admit when I'm wrong, unlike some people.
Huh. That cookie was just wrong.
Those ones that he sent me for my birthday.
So do we want to break or do you want to just roll?
We should break if we can for a minute, just to let them get set up with Bloomberg stuff.
Okay.
Okay, so we'll take, what, 5 minutes, John, or something like that, and then we'll get started.
Okay.
Maggie's giving me the eye.
Okay, well, now we'll record.
Yeah. Thank you, Dan. Okay, I think we'll get started again. We're gonna dive into domestic equity. Jason and Steve, so I'll turn it over to you and good luck.
Thank you, Mr. Chairman, members of the board. I'm Jason Brent, and I'm here with my colleague Steve Strong. And we will be reviewing the domestic equities asset class. And today we'll discuss the policies that apply to domestic equities within the different plans. We'll talk about the term passive investing, what that really means. We'll discuss some aspects of our asset class structure, as well as our process for due diligence in reviewing our domestic equities managers. And we'll discuss some of the recent initiatives that we've undertaken in the domestic equities asset class. So I think we're on tab 5, is that right?
Correct.
And so we'll start on page 3. The investment policies for the different plans, starting with the pension, you see the approved range of 23 to 35%. The investment vehicles we use, separate accounts, commingled funds, ETFs, I'll talk more about that later. The limit on small caps, which is a maximum of 10% overweight to the benchmark weight. There's no floor on small caps, but we're limited to a 10% overweight in small caps. And we must be at least 45% passive, which is not a problem since we are 100% passive. And the asset class benchmark is the MSCI USA Investable Market Index. So I'll break that down to what that all means. So MSCI is the index provider. They have a whole suite of different indexes. This particular one applies to domestic equities, that's the USA. And the Investable Market Index, also known as IMI, that is a specific methodology that MSCI uses to determine what goes into the benchmark. And if you think of the IMI as a broad index that includes large, mid, and small caps, there are over 2,000 stocks in that index. Page 4, for the Montana State Fund, you see the approved range of 0 to 15%, and that includes international equities as well. But international is capped at 4%. You see the permitted investments, equities, ETFs, investment vehicles that I mentioned we'll talk about later. And the benchmark is the S&P 500. And for the DC Plan Retirement Disability Fund, the DCRP, a approved range of 30 to 50%. In passive funds that track a broad market index, which in this case is the S&P 1500. Any questions about the different policies?
The one limit on 45% when we're at 100, does that make sense to change that someday? You just like to have that you could say you're me.
It used to apply and it doesn't really now. I foresee that ever changing, that we need to have it. I can't see that far. Turn to page 5. Mention the investment vehicle characteristics. So these are the different ways that we get exposure to domestic equities within the different plans. Starting with separately managed accounts, or SMAs. It is, so we're the only investor in this account. It requires a larger investment size. The benefits are that typically is lower cost, as well as more control on our part over the securities lending revenue split, as well as the guidelines, which is not typically quite as important with a passive vehicle. And two, there's more frequent reporting. Typically with a separate account, we get reporting of daily holdings. For a commingled fund is the other option. So if there's not the critical mass of assets, this is a cheap way of getting access to a market where the investment size is too small. So we are investors in a fund with we're an investor with other investors in this account, just like a mutual fund, essentially. And less frequent reporting than with a separate account, typically monthly reporting of holdings, and less flexibility with respect to securities lending revenue splits and guidelines. And last, exchange-traded funds or ETFs. Think of these as a basket of securities, in this case stocks, that are bundled together and trade on an exchange just like a stock. There are all sorts of kinds of ETFs, but the ones we use are passive ETFs, that is, ones that are aiming to track a specific index. And the reason we have the ETFs is to more quickly access liquidity. So when we transact in our index funds, usually there's a one-day lag. For ETFs, we can trade that same day without the lag. So an example might be, say there's economic news that comes out and the market has reacted in a strong way. And with my discussions with John, we decide, hey, we need to raise some cash, so let's do it today. That might be, a lot of cases that might be on, say, a Friday. Jobs report comes out, market reacts. We want to trade that day as opposed to waiting over the weekend to trade in one of our index funds. I'll discuss that a little bit more in terms of that process and walk through a demonstration of how we trade ETFs a little bit later. At this point, I'll turn it over to Steve. We'll start out with discussing our asset class structure. Is there any questions about vehicles?
All right, pleasure to be with everyone today. Starting on page 6, I would point out to start out with that the rest of this discussion is primarily with respect to CAP. As Jason noted earlier, we do have equity investments in state funds and things of that nature, but they're much smaller and similar enough in structure that we can just focus on CAP from here on out. So whether it be 45 or 100%, we are passively indexed. What does it mean to be passive? We're aiming to track the performance of an index. Essentially, we are deciding to follow the investment and construction rules that the index provider is creating. We're not making our own rules, we're just following their rules. Now, as we go on here, you'll see that that is not to say that this is a case of set it and forget it. We do have some control over, for example, small cap overweights. As Jason just described some of the vehicles, we have choice over what vehicles we use. So just because we say it's passive, that doesn't mean nothing goes on here. Indexes do have different rules and methodologies to determine their index eligibility. I'm going to use the example of a quality screen. The Russell indexes, for example, which you hear a lot about the Russell 2000 and small cap, for example, their goal is basically just to provide very broad market coverage, market exposure. They're not trying to say why a stock should or shouldn't be in here other than it belongs in the small cap universe or the large cap universe, for example. S&P, by comparison, when they're building their indexes, the 500, the 400, 600, they use quality screens. And so the comparable version of
we mentioned the USA IMI that we use. The Russell version of that is the Russell 3000, which by name has 3,000 names in it. The comparable version for S&P is the S&P 1500, so literally half the number of names in it, and that is primarily because S&P doesn't let just anything into their indexes. It has to be profitable for the most recent quarter and the last 4 quarters collectively, for example. So that's just one example I would give you of how different index providers go about things differently. And again, indexes themselves are not static. The Russell, for example, reconstitutes annually with a current discussion underway as to whether they should move that to semi-annually. MSCI rebalances quarterly, and there are things like IPOs and bankruptcies that can come up on an ad hoc basis over the course of a year that don't necessarily match up with any of the rebalancing schedules. So again, it's not to say that nothing happens here. Actually, quite a lot happens here. The index funds that we use currently, we have separately managed accounts for both large and small cap. Jason's going to talk a little bit later about, some of the changes we've made in the sorts of vehicles that we make use of. But a key reason that we went to the separately managed accounts was so that we get better securities lending revenue from those. We also make use of exchange traded funds, which typically, as Jason mentioned, are faster to trade. We do have those across the market cap spectrum. For our ETFs, we use S&P. There's a couple reasons for that. Number one, as I mentioned, they tend to be better quality investments overall. And the second reason, to be frank, is that there are not as many ETF options available for MSCI vehicles, which, although that is technically our benchmark for the asset class, there just are not as many options available, whereas S&P has tons of options. So those are a couple of the reasons that we make use of them. Flipping over briefly to page 7, this is just a visual breakdown of what our exposure looks like. Obviously, the vast majority of it is in large cap because that is just strictly a reflection of the way that the market actually is. A little bit less in small cap, but again, that is also separate accounts. And then all the ETFs we use collectively only represent about 5%. On to page 8. So this is, frankly, one of the key decisions that we do control, which is our decision on what small cap exposure we want versus large cap exposure. You can see the benchmark at present is roughly 90-10, whereas we are 86 and 14. We are making a conscious decision to be overweight small caps. Historically, that has been a pretty profitable way to go about it. Most recently, you hear about the Magnificent Seven, formerly known as FANG, formerly known as whatever else. Basically, a very small number of large cap stocks that are driving performance. For our part, we invest for the long term. We're not chasing performance. Small caps are still significantly cheaper than large caps. We've made a decision, as I noted, to, as much as possible, be in higher quality investments within that space. And to the extent that one might think that we're near peak rates and maybe looking for some cuts coming forward, falling rates do tend to help small. So those are some of the reasons that we have continued to maintain this exposure, even though there's no getting around the fact that in recent periods it hasn't been the most profitable trade. On page 9, speaking of tracking error, basically the difference between an investment's returns and those of its benchmark. What causes that? A number of things. Management fees is a key one. As we discussed, our separately managed index funds are very cheap, but nothing is free, and so that does tend to produce a slight drag on performance versus the benchmark. There's our SEC lending that we've talked about a couple times already. That's a positive. Securities litigation, you just never know when that might come along or what the number might be, but if we get a payout from somebody, that's positive. And securities misweights, that could be a positive or a negative. Now, our large cap index funds are what we call full replication. So they own all of the exact same stocks that the index owns in the same proportions. For small cap, that is mostly true, but there is a certain amount of optimization, which means some of the very smallest names tend to be illiquid, and so an index provider may choose to own a larger portion of another stock that has very similar characteristics, thereby replicating generally the performance and characteristics of the actual benchmark, but avoiding some of those illiquid names. There can also be misweights around the time of the index rebalancings that we've discussed. A manager may, for liquidity purposes, decide to buy a day early or a day late versus the actual rebalancing. And there again are transaction costs associated with those rebalancings. The index itself, because it's basically just a list of names, it's not a thing that you can invest in directly, does not have rebalancing costs or transaction costs, whereas in the real world, you gotta deal with that. And finally, the allocation tracking error is primarily the large cap versus small cap decision that we discussed a couple of pages ago. And again, this is an example of probably our most significant management decision that we make in domestic equities. And on to page 10, due diligence and ongoing research. We talk a lot about this because it's important to us and important to you that we do a good job of making sure that everybody stays in line. We do use the same manager evaluation framework as we would with any active manager. They have investment guidelines to follow. As Jason noted earlier, there are not as many, but they do exist. We keep a manager scorecard that tracks performance, client service, turnover, things of that nature. We do the quarterly conference call reviews with them, just like everybody else, perform quantitative analysis and do on-site visits with them. So just because they're a passive manager, they gotta follow the rules just like everybody else. How do we go about performing this research? FactSet, we've demoed for you in the past. We're not gonna demo it today because, to be frank, it's not as exciting with passive investments, but we do use it for guideline compliance and, for example, examining attribution of the large versus small decision. Bloomberg, Jason's gonna demo that for you here in just a minute. Through that, we have a trading platform that basically puts brokers in competition with each other for the ETF trades. It's not just a case of, well, we've always gone with this manager, so we're gonna go with them again. No, even with trading, we're looking for best execution. eVestment, we can examine the universe of available managers. The online trading platforms pertain to our separately managed accounts and index funds. So in the past, you might have picked up the phone and called a manager or sent, way back in the ancient days, even sent a fax or whatnot to instruct a trade. Whereas right now, our big index managers have set up their own online trading platform. So basically, we can just go in there and say, hey, buy this amount of this index fund, sell this amount of this index fund, and it just is a much more efficient means, cheaper means, faster means of going about it. Any questions I can answer for you at this point, please?
Steve, I might have missed this earlier, but what on those separately managed accounts,
Yep.
What are our average fees, or what are we paying those guys?
Are we allowed to talk about that?
Sure.
Yeah, it's 1 basis point.
Okay.
Yeah.
And is that, I guess, is the securities lending revenue factored into that, or?
No, the securities, because it's a separate account, the securities lending is handled through State Street, the custodian, as opposed to through the manager. And so it is a separate discussion. Now, for a commingled fund where that is handled internal to the fund and is handled by the manager, that would be part of the calculation. But for the separately managed accounts, it's a separate deal.
Thank you.
Having said that, I'm going to turn it over to Jason to give you some demos and such.
share my screen here. And what a absolutely essential tool it is for the fixed income team. The way I use it first would be for doing analysis of our non-core fixed income managers, and also for some of the things I'll show you right now. So when I come in the morning, every morning, I pull up 3 tabs. First one is this. This is called the worksheet. It's a list of a number of different indexes that I can track, see what's up, see what's down. Got some of the major ones highlighted here, the S&P 500, international stocks. I'll pull up this one, I can see what's happening in the 10-year Treasury. Pull up the news tab to see what's anything that might be interesting to read that's pertinent to what's going on. Now going back to the real life example of when we transact. So the last year, 18 months or so, when John wants to raise cash to help pay benefits, that decision has typically come from equities and domestic equities. And so what goes all into that thinking? Part of it is looking at the worksheet. So you can look here, this is the today's returns, and going back a month, quarter, year, and longer time periods. So typically we'd like to sell into strength, if not on that day, but also too for the trailing months or so. And we'll look at longer term, we'll look at valuations. This is something we probably have been discussing over long periods of time. And so this here shows the ratio of the PE of the S&P 500 to the S&P 600, which is the small cap. So if you look down here in the bottom graph, relative to the small caps, large caps are as expensive as they've been going back till 22 years or so. 83rd percentile. You see the .com era blip there. And so we'll look, okay, how large caps, small caps is there? Do we want to change our positioning there? And in that case, I will look at another aspect affects it. I go to see, okay, how much overweight are we in small caps? Do we want to be more overweight? Are we? Do we want to trim that? That comes into the decision as well. And then two, okay, if we're looking to maybe trim equities, what about U.S. versus international? And this is a comparison of the PE of the S&P 500 versus the MSCI ACWX US, which is a broad international index. And look here in relative to international stocks, the S&P 500 is trading as high as it's been on a PE basis, except for a couple times over the last almost 30 years. And here over in the upper right, 98th here. See that? Well, you can move that, but the 98th percentile. So all these things go into our decision making, and then the last decision would be, well, go back here too towards the valuations. So valuations aren't a great market timing signal. I think you kind of heard a little bit from that, from Becky on that. If you look at the PE of an index, what does that tell you about the next year's returns? Almost nothing. Next 5 years, that becomes tighter. If you remember that graph of the dots and the line and the trade-off between higher valuations and lower forward returns. But And then going out to 10 years, that's tighter, but right now, it doesn't tell us a lot, at least historically, it has not told us a lot about the next year's returns. But it is a gauge of a lot of things that have been going on in the market. So the last decision would be, okay, if we decide we want to sell some domestic equities, how do we want to do it? Do we want to do it through our index funds, which is through the website? They have a web portal, and Steve mentioned that as one of the things that's relatively new. It doesn't sound like a great breakthrough in technology, but I've been around long enough to have done this with a fax machine. And in my world, it's a great improvement. And it's quick and easy. And maybe we decide, okay, it's a Friday, inflation reports come out, and past sometimes has been a good one, as opposed to like one like today. And market really reacts, and let's say, hey, we need to raise some money. Say it's 25 million, let's do it through the ETFs, and then make that decision. We probably already decided, okay, I don't know, small caps or large caps. If we want to sell have a pro rata slice of the portfolio. In this case, if we want to sell ETFs, we do this. We can do this in Bloomberg now. One of the things we've done, I think since the last deep dive we did, is it used to be the way we traded through one broker, and we now use a part of Bloomberg that puts brokers in competition. So we're looking to ensure that we're getting the best pricing, best execution on our trades. This part of Bloomberg that's called RFQ, Request for Quotes, is something that we've started doing. And so in this case, you're looking to see, this would be a trade ticket. Say I want to sell our S&P 500 ETF. Here up in the upper left, you see I can either sell a number of shares, I can sell a cash value. Allocation, so there we go. So right here, I've got to tell it what account to allocate this to. So we're taking this money for selling an ETF, we're taking out MU48, which is the account number for domestic equities. Again, here I can pick shares, cash value. It's pretty quick. Next thing I do is I'll click send it to the desk. At this point in time, it will go through the compliance procedures and check to make sure that we're selling an ETF that we own, that we're not selling more of an ETF than we own, and that it's an ETF that's on our approved list. And it will then show up, if that's approved, it will then show up on this screen, which is kind of a trade blotter. It shows all the trades that are being worked on. So in this case, here we have, this was a test that we might actually do it because I don't want to try to sell one share, but you see the right click, here is the request for quotes, RFQ that I mentioned. And it will send us, actually it will send us to a screen that looks like, let me change, I'll take that. The pop-ups aren't visible, so I'll show you a picture of what that actually looks like.
You're not gonna actually sell one share?
No.
Okay.
I guess not.
That'd be enough for today.
Now you'll buy it.
How many cows would I have to sell? Just kidding.
Today, fewer.
Now I looked at the market.
So this is next screen. So at the top, if this were live, this would be changing. These are the current trades that are going through for this ETF. Look down here in the middle. So we can sell We can buy, we can sell, we can do one-way or two-way. A one-way trade is, in this case, we would be selling. The brokers that you see down below that will be bidding on this know that we are selling. A two-way trade is that we put this out after I hit the send button, and they don't know if we're buying or selling. So they've got to bid on both. You see the amount we're trading, the bid and the offer, so I've got to buy it higher than I can sell it. And a very tight bid-ask range for this ETF, which is very, very, very liquid.
Who sets those numbers?
What's that?
Who sets those numbers, the bid and the offer prices there?
Sorry, I didn't.
Who sets those numbers? The
It's in
26?
the market.
It's the market.
It's the market's,
And that's tight.
and so, can't do it here, but I'll hit the send button. And if you see in the middle of the screen, it says RFQ timeout. I've set it to be 300 seconds. That I will let these brokers bid. And then from there, now I can cancel it, I can extend, I can make it longer or shorter, but I'll switch back here to.
The brokers that come up on the list, are they all approved brokers?
Those are approved brokers that we've all gone through a process with of being set up with them, and operations has done all that work to make sure that we can communicate with them. That back on the allocations tab, or the next one over is the cost. It automatically populates with our commission that we've had agreed upon with the brokers. So the brokers are bidding and the prices are changing, and so typically on one monitor I'll have that, and on the other monitor I'll have this, which is after the market closed, but this is the real time price for the ETF. And not a real scientific way, but if it's going up, I might just wait to hit the button. If it's going down, I might hit the button a little quicker.
Well, that makes good sense.
And then once I do that, then operations will process the settlement and so on and so forth. But I think the most important part of that is going back to the RFQ part, where we can now ensure that we're getting best execution by having multiple brokers bidding and competing for a transaction.
Is there one that we use more often than not, or just very different times?
I think there kind of tilts towards a couple. A couple that may not be household names, but are very big in ETF trading that can make a bit more competitively. But we're not picking the brokers necessarily. I mean, if we had a problem with a broker, that we can unclick them from the list and they wouldn't see it.
So with the list that you get, you've already preloaded, here's our approved brokers, and they're the only ones that can bid on when you're doing your business. Okay.
Any other questions about?
I have a question. So when you say you click it when timing you think, so how long do you have to wait for operations to approve it? Is it fairly quick?
It's internally, so I don't have to wait. So with the index fund trades on their platform, there is a process where neither Steve or I can approve that trade, operations has to.
Okay.
But within Bloomberg, with the trading system, those guidelines are preloaded. And so it's reading through to make sure that we're not doing anything we should be doing or can't be doing.
So when he hits the button, the trade is done.
Okay, that's what I was.
Almost instantaneously. There's still an operational process
Because
of
it
then
looks-
settling it and.
Yeah, so I send it to the desk, it shows up in the trade blotter, I hit the RFQ. Send,
That's what I was wondering,
and
if
then
it's that quick.
And we're having fun and lunching, yeah.
It's all about timing.
It's very similar to what Kirsten does
Yeah.
with them.
That's right.
Those settle T+1,
What's that?
1 day.
T+2 until May 28th.
It's coming.
And that whole process is new since Jason became Director of Public Markets.
What does T+2 mean?
And it takes 2 days for the trade to actually settle, so we agreed on the price, but the actual exchange of money and whatnot takes 2 days.
Why did they go to 2 days? Just,
They're going to
It
one.
was 2, it's going to 1.
oh, it's going to one.
It's been two
Yeah.
forever.
Wow.
It was 2 because it took them that long to know electronic stuff. We can do it faster. And they're actually supposedly looking at going to like T+0 like same day. Hasn't happened, but yeah, they're talking about it.
Every day. If no more questions about Bloomberg or trading, I'll move to, see, we're on page 12. It shows the ownership among the different plans, as well as the performance track record. Obviously, the vast majority of assets, domestic equities are held in the pension plan. And just quickly, so the differences in performance, if you look at that, really is due to different benchmarks. As I mentioned in the policy part of the presentation, different benchmarks, different exposures, different returns, as well as for the pensions, if you go back out to the 5 and 10-year return, that includes the active management that we had at the time.
Jason, I don't know if you care, but just skip slide 11. If you want to talk about that.
Yeah. So I mentioned some of the things we've done recently. So if you rewind even further back before we had the large cap separate accounts for index funds, we transitioned those. Those used to be in commingled funds. This was, I think, 2017. And we had the large caps in separate accounts and then the small cap index fund in a commingled fund. And that's one thing that we were able, with the sufficient assets to do, to transition that into the separate account, and again, get the benefits of lower cost, more frequent reporting, better split on securities lending revenue. And 2, with some of the ETFs, again, big one was trading, using the new trading procedures, using RFQ to put brokers in competition. We switched a couple ETFs to lower cost alternatives for both large cap and small cap ETFs. We added an all cap ETF, so that would be a quick one in case I didn't want to change the allocation. I just wanted to, if we're looking to trade quickly and trade a large slice of the portfolio, you can do it that way. And again, too, Steve kind of mentioned it, but the new small cap ETF that we transitioned to, apart from having lower cost, also has more of a quality bias, which we think should pay off long term. And so I think that's it for the recent initiatives. I don't know if you have any questions about that. And page 13 kind of shows the summary again of what we talked about, what passive means, the way we view it. Indexes are constructed as an active decision on the provider's part, and that indexes are not static, they change. Talked about tracking error, why our performance may not be exactly that of our benchmarks. Talked about the different vehicles, separate accounts, commingled funds, ETFs, and our market exposure, small cap and large cap. And to our process, which emphasized that our process with our index fund managers is the exact same as we do for our active managers. So that's all I have.
Any questions?
Any questions?
Okay, well, thank you. And we're,
Dan, we need bigger screens so that we can see these things when we're doing
Put one right behind you.
maybe better glasses would help too.
I will take it under advisement.
So do you have any to-do list?
No, other than just warning everyone, May will be busy. Quite a few investment policy statements to look at, quarterly deep dives, likely at least one more investment policy statement relative to the debt-free account before the end of the fiscal year. Oh, and then changes in the workforce housing project in Deer Lodge. So I will send materials out. We will do our best to get materials out early since there'll be so much. Hopefully Savvy, I'm looking at mailing day is the 10th, is that right?
That's what it says here, it's on the calendar.
Okay, so we will bump that up and try to get it out. We'll get it out the 8th.
Or I can come by and pick it up.
Okay.
How about a 2-day meeting for sure?
2-day meeting for sure. Yep.
We can
So
plan on
let
that.
Savvy know if you need rooms and we'll plan a dinner that night to.
Yeah, that'll be good. I always enjoy that, so. Any questions or anything else that we need to do or look at? Seeing none, call the meeting adjourned. Thank you all.
Thank